We have officially crossed the line that most investors never see coming until it's already behind them. For years, this channel warned that the silver market was not merely undervalued but structurally broken. Suppression was not a theory, it was a mechanism. Prices were held down not by natural supply and demand, but by leveraged paper promises and the assumption that no one would ever demand delivery all at once. And now that assumption has failed. What happened is not a rally. It is not excitement. It is not optimism. It is a rupture. Silver didn't move higher in an orderly fashion. It didn't climb. It detonated. A double-digit percentage move in a single session is not how healthy markets behave. Commodities do not rise 10% in one day under normal conditions. That kind of movement only happens when something snaps underneath the surface. When forced buyers replace willing buyers. When survival replaces strategy. When a system stops negotiating and starts liquidating. Somewhere a massive short position reached its breaking point. Margin calls were issued. Collateral failed. And the clearing process took over, turning risk management into a blind algorithm with one instruction: buy at any price immediately. In thin liquidity with no seller stepping in, price didn't travel. It teleported. That vertical line on the chart is not bullish enthusiasm. It is the footprint of failure. This is why this moment matters. Because once forced liquidation enters the market price, discovery changes forever. The old rules stop applying. Resistance levels become irrelevant. Analysts arguing about fair value are left behind. What remains is urgency. Fear on one side, disbelief on the other, and a rapidly shrinking pool of real metal in between. We are standing at the edge of a new phase, not just for silver, but for confidence in the paper system that priced it. This chapter is the opening signal, not the climax. And if you are watching this now, you are early to the realization, even if the price no longer feels early. The event horizon has been crossed. There is no rewind. If this analysis resonates with you, press 1 in the comments to confirm you're still with me, and subscribe so you don't miss what comes next. This story is just beginning. To understand why this move was so violent, you have to understand what forced buying actually looks like inside the machinery of the financial system. In a normal market, price is discovered through negotiation. Buyers wait. Sellers hesitate. Liquidity forms a bridge between opinions, but in a liquidation event, that bridge collapses. The market stops being a conversation and becomes an emergency exit. When a leverage fund fails, control is taken away from human decision makers. The clearing system steps in and executes without judgment, without patience, and without regard for price. The objective is not profit. It is containment. Positions must be closed immediately to prevent losses from spreading further. This is where price loses its meaning and speed replaces logic. What we saw was the order book being consumed in real time. Every sell order was lifted not because someone believed silver was cheap, but because someone had no choice. Volume surged not as confirmation of optimism, but as evidence of stress. This is the signature of a short squeeze moving from theoretical to systemic. Retail shorts go first, then family offices, and eventually institutional funds with balance sheets large enough to distort markets when they fail. This is the moment where dominoes stop falling one by one and start collapsing in clusters. Because large shorts are not isolated bets. They are embedded in portfolios hedged against other positions and intertwined with credit lines. When one leg breaks, the strain transfers across the entire structure. That is why a 10% move in silver is not about silver. It is about the stability of the framework that allowed that position to exist in the first place. At this stage, sellers disappear, not because they want higher prices, but because they don't trust settlement. When counterparty risk enters the equation, paper claims lose credibility. The fear is no longer missing upside. The fear is not getting paid. And once that fear spreads, liquidity vanishes faster than any algorithm can replace it. This is how localized stress becomes systemic pressure. Not through headlines, but through margin calls, collateral gaps, and forced execution. The market is no longer pricing on value, it is pricing survival. And that shift is irreversible once it begins. Now we need to zoom out, because silver never moves alone. It has a shadow, and that shadow is gold. Gold is the anchor of the precious metals complex, the signal that tells you whether a move is speculative noise or a structural reset. And right now, gold is not whispering. It is confirming. Gold holding extreme levels is not a coincidence. Historically, gold leads, silver follows, and then silver accelerates. When gold establishes a new plateau, it gives algorithms and institutions a reference point. They don't ask whether silver should move, they ask how far behind it is. That gap is where the chase begins. The gold-to-silver ratio is one of the oldest valuation tools in the market. When fear rises and currencies weaken, that ratio compresses. Capital rotates from the larger, more stable metal into the smaller, tighter one with higher beta. That rotation is mechanical, not emotional. Models trigger. Funds rebalance. Momentum strategies activate. Silver becomes the expression of the same macro stress amplified. This is why vertical charts feel unnatural. For years, silver was conditioned to move slowly, capped by paper supply and controlled volatility. That conditioning trained investors to distrust sharp advances. But once gold validates the move, that conditioning breaks. The suppression phase ends and the catch-up phase begins. This catch-up is powerful because it is fueled by math, not opinion. If gold reprices first, silver must follow to restore balance. And the longer silver lags, the more aggressive the eventual move becomes. That is what we are seeing now, not exuberance, but compression releasing. What makes this moment dangerous for skeptics is that silver still appears cheap relative to gold even after a historic day. That perception invites capital at the worst possible time for those betting against it. It pulls in algorithms designed to exploit ratio dislocations and forces late shorts into impossible decisions. This is the transition point from disbelief to recognition, from denial to momentum. Gold has spoken and silver is responding, not politely, not gradually, but all at once. While price action is unfolding on the screen, the real stress is building. Where most investors never look, the physical market. This is where paper narratives collapse because metal cannot be printed, rehypothecated, or delayed without consequence. When price moves faster than logistics, the illusion of abundance disappears. As silver surged, physical dealers didn't raise prices. Many simply stopped selling. Sold-out site maintenance call for pricing. These are not marketing tactics. They are warning signals. When volatility exceeds software limits, dealers step back because quoting a price becomes a liability. If metal gaps higher overnight, every posted price becomes a loss. This is how a paper spike transforms into a physical shortage. The screen price freezes while the street price runs. Coins, bars, and industrial supply begin trading at levels disconnected from official quotes. At that point, spot price becomes theoretical. What matters is availability. Can you get the metal at all? And if so, how much are you willing to pay? This is the definition of a currency crisis. When goods cannot be purchased at the official price, the currency used to price them is no longer trusted. People don't ask what silver costs. They ask whether it exists, and that question alone shifts behavior across the entire system. Industrial buyers feel this first. They don't speculate. They consume. When supply becomes uncertain, cost becomes secondary. Contracts include force majeure clauses, and in extreme volatility, those clauses get activated. Deliveries are delayed. Shipments are renegotiated. Manufacturers are forced into the open market to compete with investors for the same ounces. This is where panic buying begins, not driven by greed, but by necessity. When industry enters the spot market, it removes supply permanently. That silver doesn't return to vaults. It becomes product infrastructure technology. Once consumed, it is gone. This is why vertical price moves don't resolve quickly. The metal is leaving the system while demand accelerates, and no chart can model that in advance. Now we need to talk about what happens when this kind of stress collides with the rules of the exchange itself. Futures markets are built on the assumption of orderly movement. To protect the system, exchanges install circuit breakers, daily price limits, designed to slow things down when volatility becomes extreme. But these safeguards are not solutions. They are pressure valves. And when pressure keeps building, freezing, the market doesn't remove risk. It concentrates it. With silver already sitting near historic thresholds, even a modest gap higher at the open is enough to trigger a limit event. When that happens, trading halts. No buying, no selling, just a frozen screen. For long-term holders, this feels validating. For anyone short, it is pure terror. Losses continue to grow, but there is no exit. Time becomes the enemy. This is how panic compounds. A halted market doesn't calm participants. It traps them. Short sellers know that when trading resumes, price often reopens higher. That knowledge forces them to line up, buy orders for the next session regardless of cost. Those orders then create the very move they fear. It is a feedback loop, and once it starts, it feeds on itself. We have seen this before in smaller markets: nickel, lumber, energy. Each time the result was the same. Liquidity vanished, trust evaporated, and price discovery reappeared at levels no one had modeled. Silver is larger, more embedded, and more politically sensitive than any of those, which means the consequences are amplified. This is not a market for leverage. Volatility of this magnitude destroys margin accounts, even if the trader is directionally correct. A $5 swing becomes routine. A $10 swing becomes possible. Survival favors those who hold unlevered positions and can wait. The exchange can slow trading, but it cannot create metal. And as long as demand exceeds deliverable supply, every pause simply delays the inevitable adjustment higher. The machinery is straining, and the limits are no longer a ceiling. They are a signal that the system is losing control. At this point, attention shifts from traders to institutions, because institutions move markets when they are forced to react, not when they plan to. For months, large funds expected to enter silver later. They penciled in allocations for the new year. They assumed time was on their side. That assumption just collapsed. Institutional capital is not patient capital. It is benchmarked, ranked, and constantly compared. When an asset moves 10% in a single day, it stops being ignored and starts being chased. Performance pressure takes over. Funds that are underweight silver suddenly face a career risk. Not owning it becomes more dangerous than buying it late. This is why sharp moves attract money instead of repelling it. A violent breakout signals opportunity to momentum-driven strategies. Models don't ask whether the price is high, they ask whether it is accelerating. And acceleration is exactly what a forced liquidation produces. As these funds step in, they don't buy small, they buy in size, and they buy regardless of short-term volatility. Their entry compresses supply further because they are not trading in and out. They are reallocating capital. Once that capital enters, it stays until a new equilibrium forms. But this is also where turbulence increases. Early holders begin to see gains that feel unreal. Profit-taking emerges. Pullbacks become sharp and emotional. A $5 drop feels catastrophic to someone who just arrived, even though it is meaningless in a vertical market. This is where weak hands exit and stronger hands absorb. The key distinction here is trend versus noise. In a repricing phase, corrections are not reversals. They are pressure releases. Each dip transfers metal from impatient holders to entities with longer time horizons. That process strengthens the trend rather than weakening it. This is why discipline matters now more than ever. Emotional reactions are expensive. Overconfidence is punished. Fear is punished faster. The market is no longer forgiving because it is no longer balanced. It is transitioning. The institutions are waking up, and when they move, they don't tiptoe. They reshape the landscape. When markets move this violently without a single clear headline, it usually means the headline hasn't reached the public yet. Price moves first. Information follows. This is one of the oldest rules in financial markets, and it is especially true in commodities tied to geopolitics, industry, and sovereign interests. A sudden 10% move is the market signaling that something is breaking behind the scenes. It could be stress inside a financial institution. It could be a settlement failure. It could be an interruption in supply that hasn't been formally announced. Whatever the cause, someone with better information is acting, and they are acting with urgency. This creates information asymmetry. Insiders position themselves quietly while the public debates narratives. By the time confirmation arrives in the news cycle, the price has already adjusted. That is why waiting for certainty is so costly. Certainty always comes at a higher price. At this stage, rumor itself becomes fuel. Whispers about counterparty failures, delivery delays, or emergency meetings don't need to be proven to affect behavior. They change incentives. Sellers hesitate. Buyers accelerate. Trust erodes. in markets built on confidence that erosion is enough. This is also where global dynamics matter. Silver is not priced by one country. When stress appears in one region, capital shifts through time zones. Asia reacts to New York. Europe reacts to Asia. Each session inherits the anxiety of the previous one and adds its own urgency. Price gaps replace intraday movement. The market no longer sleeps. This is how localized disruption becomes global repricing. Not through a single event, but through cascading reactions across regions that no longer trust the same assumptions. And once that cascade begins, there is no central authority capable of reversing it quickly. The market is telling us that something significant is unfolding. The price is the message, everything else is noise. As the financial system reacts, industry does not wait for explanations. It acts. This is where silver's unique role becomes impossible to ignore because, unlike many assets, silver is not optional. It is embedded in production. Energy, electronics, defense, medical technology, when availability is questioned, procurement behavior changes instantly. Industrial buyers are not speculators. They don't debate charts or ratios. They manage continuity. A factory that cannot secure inputs does not slow down gracefully. It stops. That risk is existential. So, when price volatility signals potential shortages, cost becomes secondary to certainty. Paying more is preferable to not receiving metal at all. This is how off-market transactions emerge. Long-term contracts are renegotiated. Suppliers invoke clauses. Buyers bypass public exchanges entirely and strike private deals directly with producers. Metal that once flowed into transparent markets disappears into closed supply chains. From that moment on, it is no longer part of available inventory. It is spoken for. This privatization of supply is invisible on price charts until it suddenly isn't. Official production numbers may look stable, but deliverable supply collapses. Vault inventories drain. ETFs struggle to source metal. Futures contracts settle in cash instead of ounces. Confidence in paper exposure erodes further. At the same time, the public begins to wake up, not because of fundamentals, but because of movement. Sharp price action captures attention in a way years of analysis never could. Searches spike, retail orders queue up while markets are closed, demand stacks quietly waiting for the next open. This is where scarcity accelerates. Industrial demand removes supply permanently. Retail demand removes liquidity unpredictably. Institutional demand removes flexibility. And none of them coordinate. They simply react to the same signal. The system was built to handle one of these forces at a time, not all of them together. That is why stress multiplies instead of dissipating. The metal is being pulled from every direction and nothing is replacing it fast enough. When pressure builds across financial, industrial, and retail channels simultaneously, the weakest link is always the intermediary. Futures markets are zero-sum systems. For every winner, there is a loser. And when price moves violently, those losses do not stay contained. They concentrate. The scale of this move tells us the losing side is not retail. Small traders cannot absorb multi-dollar swings. They are eliminated early. To withstand this kind of damage and still function requires balance sheets measured in billions. That points directly to systemically important institutions. The same entities responsible for providing liquidity are the ones now under strain. When a clearing member fails to meet a margin call, the exchange steps in. It seizes collateral, liquidates positions, and attempts to contain the damage, but containment has limits. If losses exceed posted collateral, the exchange draws from its default fund, a pool financed by other members. Losses spread laterally. This is contagion. One failure weakens others. Liquidity is withdrawn. Trust erodes. Banks begin to question each other's exposure. Lending tightens. Stress leaks into unrelated markets, bonds, funding rates, credit spreads. What began as a metals trade becomes a balance sheet problem. This is why central banks eventually appear, not to save silver traders, but to stabilize the plumbing of the system. And stabilization always requires liquidity. New liquidity dilutes currency. Diluted currency pushes hard assets higher. It is a self-reinforcing trap. Attempts to suppress price to protect institutions backfire because they signal weakness. Every intervention confirms scarcity. Every reassurance accelerates demand. Confidence cannot be restored by decree once it has cracked. This is the stage where markets stop reacting to policy and start forcing it. The metal is no longer a trade, it is a verdict on trust. This is where strategy replaces emotion. In a vertical repricing phase, the real risk is not volatility but poor decisions made under pressure. The goal is no longer to chase price but to understand the cycle and act with discipline. Silver's move is not speculation. It is a shift in trust away from promises and toward possession. That shift unfolds in stages: disbelief, chaos, then acceptance. Most people fail not because they are wrong, but because they react without a plan. Ownership matters more than timing. Leverage magnifies mistakes. Paper exposure adds counterparty risk when counterparty risk is rising. Physical assets remove dependence on fragile systems. They are not efficient, but they are resilient. Vertical markets also test psychology. Large